you all. We appreciate your coming. We appreciate your registering for this webinar. We appreciate your engagement so far. I'm sure this is the day we have all been looking forward to, and I'm excited to be here. I'm so excited to be here. I'm happy. I'm glad. I don't even know the words to express my feeling this morning because this is the day we have been looking up to, sending WhatsApp messages, going promotional tools on our social media. It's like, the day is here and it's finally here. And I'm sure everyone is excited. I am delighted to have you all here. Trust me, this is a day and this is a webinar that you have to profile, keep somewhere, go over it again and again and again so that you can digest it, understand better, and make your business grow. Sometimes you wonder why you make sales, sales, and your revenue is not revenuing. Yes, today is the day that you're going to learn. Everything will be practical. Trust me. Practical, insightful, engaging. All those hidden secrets will be let out of the bag. So I can see that we have so many people joined this morning. Should I call out your name or you want to introduce yourself? Please, I will be glad to have you introduce yourself. If you feel like you want to unmute yourself, you can do so. Or you can go to the comment section or the chat box. Tell us your name, where you are joining us from, what you do. You never can tell. You might have a customer right here. You might see somebody in the same location that you can connect with. So let us know you, your location, and where you are joining us from. So the floor is open. If you want to unmute yourself, go ahead and do so. And if you want to use the chat box, please do so. So the floor is open. Let's have you. Thank you for joining. I can see you, Rashidat. Rashidat joining from Lagos, Nigeria. Rashidat Bello, you're the founder of Yaloja. So that's where you can get your farm produce from farmers and they deliver to your doorstep. Welcome, Rashidat. Welcome, Deborah. Hello, please, sorry about that. Can you still see me? Can you still hear me?
And you can go ahead.
Yes, ma. So we have Temilolu Washofumi, we have Mercy Oluwashemilore. Welcome. We have Bin Kadrio. Welcome everyone to our webinar today. As I said earlier, that we are so excited to have you here. And believe me, this webinar that have something practical, strategies and insights that you will take away. So if you have your pen, your paper, your jotters, just keep them handy because trust me, it will be useful. And if you have any question, there'll be time for question and A. So during that time for Q&A, you can ask your question. Those questions that have been bothering your mind, those things that you need clarification about, those things that you think you don't understand, but you want to know better, you have the opportunity to ask those questions. So there'll be time for Q&A. So you can ask your question, and I promise you, you'll be glad because you have answers to the question. We are not here alone, and we've gone far and wide to get to a speaker, someone with experience or experiences that will help you grow your business to something investable, where you can have investors coming in, customers tripping in because of the value that you are going to get from today's webinar. So I will like to introduce our speaker. But before I introduce our speaker, let me go ahead and read this bio for us. And something that some professors or doctors, when you want to introduce them, you just go say Mr. or Mrs. Ha, you can get it. You get it hot from there because they will ask you, where were you when I was obtaining my degree? So our speaker for today is um, PMP, CMGR, MCMI, NBDSP, CPP, FMVA, LSSBB, NBSP. You can see that his portfolio is loud. His portfolio is large. So it's not everyone. So let's go ahead and see who our speaker is. Who want to know? I want to hear the bio of our speaker. Let me just see your comment. Let me just see your emojis in the comment section. Show me your emojis if you want me to read out my speaker's bio for you before he comes up to speak to us. Let me have you. Let's see you. Yes, I can see those thumbs up. All right. So our speaker's bio. Mr. Idris Sheru Ibrahim is a results-driven chief operating officer, a financial advisor, and a transformative leader with over 20 years, as in 20 years of cross-functional experience spanning operations, finance, audit, and organizational strategy. So it's not someone that just started. It has over 20 years of working experiences. It specializes in building founder-independent operating models by integrating Lean Six Sigma methodologies with AI workflow motivation, replacing fragmented manual reporting with real-time automated system of accountability. He currently serves as Chief Operating Officer at Asatura Technology Service, where he leads a global vision of AI integrated ed tech, overseeing the development of the MySlate learning platform and Asatura Bean Fin, a mobile-first financial management tool serving over 50,000, I repeat, serving over 50,000 informal traders. Alongside this, he is a transformation partner at Project and Co, supporting senior leadership teams through complex organizational change and serve as a financial advisor and auditor to startup Kano as role a role he had since held since 2021. In its capacity, it provides independent financial advisor support, design and strengthen internal control system, leaks budgeting and forecasting cycles, and ensure rigorous compliance with donor rules and reporting requirements across grant-funded initiatives. Its career reflects a consistent trend of financial stewardship and operational discipline. From a 12-year tenure with the UK Department of International Development. So he's not a local person, he's a global man. And subsequent finance and operations leadership at Admin Smith International on the DFID-funded MAFTA program to senior audit, compliance, and finance role at Lebanon Rice Mill International, and operation leadership for Tony Blake Institution for Global Change on the project for agricultural coordination and execution within the office of the Vice President. Across these engagements, he has managed multi-million pounds budgets with zero tolerance for financial leakage, engineering internal audit frameworks, and safeguarded regulatory compliance, and serve as a primary liaison between technical delivery teams and international donor auditors. So with me here, we have Mr. Shehu Ibrahim Idris. With our clap emojis, thumbs up, love, and anything you want to use, let's welcome our speaker to take the mic from here. Welcome, Mr. Shehu, PCP, ICA, CCA, ICAN. Welcome on board.
Thank you so much, Anne, for all these accolades. You have pampered me a lot. Thank you so much. So, very good morning.
You're welcome, sir.
Yeah, very good morning to you, esteemed participants, SMEs, distinguished staff of Clean Tech, very hardworking staff, very dedicated, very committed. I think this commitment has been demonstrated a lot. In fact, right from the time we agreed for this class, I think Anne has been very consistent, very committed, Nina and other team members. So thank you so much. Hello?
Thank you, sir. Welcome, sir. We can hear you, sir.
Okay, thank you so much. Yes.
All right. Sir, please, you can amplify your voice a bit so that we can hear you clearly.
Okay.
Yes, sir. Thank you, sir. We appreciate that, sir.
Okay. So, can you hear me very well now? Is it better? The audio.
It's better, but we have like a bit of background clicking somehow, but it's better. All right, sir.
Is it better now? Is it getting better? Possibly it's the network because it rained heavily here in Kano last night. So it has completely affected the network. Is it better now? Hi, Anne?
Yes, it's better. Thank you.
Better. Okay, better than what it was. Right, thank you so much. So, am I good to go? You have finished introductions?
Yes, sir. You are good to go, sir.
Okay, so thank you so much. And once again, the distinguished staff of Clean Tech, esteemed SMEs here, and ladies and gentlemen, good morning to you all. First, I actually appreciate your time, your support. Most of you have very serious commitments, and you have to exchange by way of opportunity cost those commitments to devote your time to listen to this conversation on pricing. So I must say thank you so much for this. So without wasting much of our time, let me go ahead and share my screen so that we can just start the business of the day now. Just one moment. I'm wondering, can everyone see my screen? Can you all see my screen? Hello?
Yes,
Can you
sir,
all
we
see?
can see your screen.
Oh, you can see my screen very clearly.
Yes, sir.
All right. So thank you so much, and you are very much welcome once again. So today we are going to look at the revenue pricing, pricing as the main driving force for SME profitability and scale. Uh, I've already been introduced, so it's just for me to go ahead and start speaking to you about pricing revenue. So one thing I want us to have in mind with this code, revenue is vanity, profit is sanity, cash flow is reality. So these are fallacies or some kind of what that we will come to appreciate in the course of the presentation. So, but one thing is very clear: pricing is a very critical thing to even a profit and non-profit organizations, government agencies, charity organizations. Pricing is very, very critical and very, very important, as we will see while going through this exercise. So, to so many people, revenue is like profit because someone will say that, okay, I have been able to raise a revenue of 10 million. So, thinking that that's the profit. So, you are far away from profit actually. So, the revenue is the big picture. So, now as business owners, SMEs, uh, people doing one trade or another, so this will actually see you through a whole round of exercise that you appreciate. Okay, what is revenue? What is profit? What is gross profit? What is net profit? So we are going to look at it here. So, but we have to bear in mind that the issue of pricing is a critical thing for any business.
Hello, sir. Please,
No,
sorry to cut you in. Please, you are not presenting your slide. We are not seeing your
you are,
presentation.
you are not seeing me, right?
Yes, sir. Or
Or
we can help you project it
okay,
if you don't mind.
okay, no problem.
All right, sir.
Sorry for this, ladies and gentlemen. Perfect. The screen is on. I can see the screen. Hope anyone can see.
Yes. Yes.
Okay, perfect. Okay, uh, so our discussion is on pricing. Pricing is a determinant factor for any business to survive, to sustain its operation. So, to many people, pricing is approached in several ways. So, but we want to look at it now here in a manner that is more sane, more intelligent, and more vibrant. So, for most of us that are SMEs here, you've invested millions of naira in terms of your business. You can afford to approach pricing in a manner that a trader on the street who is not knowledgeable in the business that he's even doing would approach his own pricing. So that's why this kind of event and activity is very important for us to look at pricing in a more vibrant way. So you'll all agree with me that pricing is the main driving force for SME profitability and scale. Not only SMEs, in fact, even not-for-profit organization, the way they actually tailor their activities, uh, programs, and projects. If those activities, are not priced well or budgeted well, then it cannot be sustained. So maybe can we get to the next slide? Perfect. So what are we saying here? Revenue can fool us. Yes, as I mentioned earlier, someone could even make a huge revenue and be happy that the business is growing, the business is doing well. But there are other underlying factors that person has to put into consideration before you know whether the business is well, whether the business is sick, whether the business needs a kind of diagnostic, and so on and so forth. So revenue is just the big picture, and it can always fool us. So the only way, when at times you can see a business very busy, very vibrant, recording businesses. Just last week, I was in Abuja to train management staff of a veterinary service company. In fact, when I got there, the business was so busy, everyone was busy. I couldn't even deliver the training on the very day that I was supposed to deliver because of the way the business was so, everyone was so up and doing, running their businesses, everything was going on. So beneath that busy, the business was in the state of which the business is. Beneath the hustle and bustle of the business, lies a lot of criticalities. The business was actually operating at a loss, but even the owner of the business could not decipher that because, as far as the business owner was concerned, the business was bringing in a lot of revenue, a lot of traction. Until such a time that we settled down, we went under a kind of training, then things started coming out that there were a lot of challenges. So this is the reality of things with business, and it actually informs my the fact. It actually informed the fact I mentioned earlier that business can be profit can be revenue can be vanity, rather profit can be sanity, cash is reality. So now when a business is very busy but broke, what is that suggesting? Okay, I understand that my system value is, I wonder, I think in fact I've reached the ultimate volume. I don't know whether I'm still audible. Am I still audible? In fact, I extended the volume to the end, 100%. Possibly,
That's fine. You can go ahead, please, sir.
okay, you can still hear a bit?
Yes.
Okay, okay, okay. So, being busy, while a business is very busy, it doesn't actually indicate that the business is raking in profit. It could be very busy making sales, getting revenue, but at the end of the day, the reality may not be the same. So that's why we we think profit is sanity because you can only arrive at a profit when you have a very good price. So price with a flow where you track your gross margin. Gross margin will come to know of it later in the course of the conversation. Operating margin, net margin. So all these are components of revenue that will eventually lead you to the profit. So every sales should clear the economics of the business, the gross margin, operating margin, net margin. So all this must come into play before you get to the stage of the profit. Then again, cash is a reality because at the end of it all, after all this struggle, after all this hustle and bustle, after all this state of being very busy, if at the end of the day there is no cash in the bank, then everyone will be disappointed. If a business cannot fund its operating costs, cannot pay its salary, cannot go back and get more inventory because the cash is gone, then the reality is that the business is sick. So, which means cash is even with the revenue, with the profit. Then, cash, the eventual cash, is actually the determinant of sustainability and growth of the business. Yeah, next slide. It looks like we lost the slide. Nina, and the slide.
Yes, the slide's coming up. One second, please.
Okay, okay. All right, thank you. Next slide. Okay, yeah, we can go to the next slide. But what we need to consider here is we need a mind shift from top line vanity to bottom line sanity. So now, if we agree that revenue is vanity, why do some SMEs still chase vanity? It's a question for us here in the room. We agreed, yeah, revenue is vanity, profit is sanity, cash flow is reality, but we still chase vanity. So I think it's a question that we need to have in our mind. Why do some SMEs chase vanity? That is high revenue when at the end of the day can lead us to be in a loss position, a situation whereby we cannot even acquire the cash. Then again, another question: what silent trap has eroded profits in a business you know? In another business that you know, maybe some of us are SMEs. They have been into one business concern or the other. They have developed one initiative and purposefully failed and had to uh, go into another initiative. So maybe have we been able to figure out any silent trap that has eroded our profit? In fact, there are a lot. More especially doing business in Nigeria, more especially a business, family-related business, you are bound to have a lot of trap around free gifts, freebies, discounts. So all these are silent killers of business because you give the discount like not technically debated upon or not something that you structurally develop to do. Just a discount, possibly the person you award the discount to has the potential to create more opportunities, business opportunities for you. So these are the sort of silent killers that one would have actually faced in a previous business endeavor. So maybe we move to the next slide. Okay. So this is very important. Now, I actually mentioned that a common trader on the street can fix price. Mama Elizabeth, who is selling bean cake, can wake up in the morning, fix her price based on the market trend of other bean cake sellers around her. Maybe Mama Clara is selling her bean cake at one piece of bean cake, possibly at possibly 10 naira, and Mama Elizabeth has been selling for 7 naira. So Mama Elizabeth can possibly, looking at the market trend, also follow the bandwagon approach and increase her price. So, and there will be an attendant effect of possibly losing customers, and by implication, having large inventory of bean cake unsold, or she may still gain customers who possibly see a kind of quality, marginal quality change in the presentation of the akara or something like that. So, but then the wisest thing to do for people like us now who are into real serious business, we have studied the business, we have done a lot of business planning, we have done a lot of feasibility studies, financial analysis, and other analysis. So we can't jump into pricing just like that off head. So, what most SMEs most SMEs actually track revenue. Far fewer can explain what happens after the sale. So a lot of SMEs may be able to track their revenue. Others, well, once my bank account is actually increasing in size, I know that the business is doing well. So, but this is actually wrong. We need to capture some metrics. So this, like these five core metrics, we need to capture them before arriving at a price. So for instance now, 85% revenue, if we make sales, we record 85% revenue. What is that saying? It's a top line. So it's a vanity as we mentioned, the revenue. So and we need to look at it. Okay, we have 85% revenue, 45% gross margin, 30% operating margin, 20% profit, 20% cash flow. So revenue is our total sales, the income that came from the core activities that we are doing, selling product and services. Then the gross margin, is the cost relating to offering this course or these services. Some will call it cost of goods sold. So the margin of that cost of good in relation to the revenue that we make. So 45% is a decent gross margin for some businesses. Some businesses could even record 70 or even up to 80% gross margin. Like rice mill, I hope in a rice mill is a very delicate uh, industry and value chain. So if you are able to make a gross margin of 60, 70% as a rice miller, this is a very decent figure. So what about the operating margin? Operating margin now has to do with the cost, the margin that measure the cost of your operation, admin, factory related expenses that are mostly fixed in nature, rent, salaries, depreciation, insurance, sales and marketing. So all these costs account for your operating margin. Then now the net profit, what do you take home? 20% from your sales. For instance, for every 100 naira that you make in your sales, or maybe 85 naira that you make from your sales, 20% or 20 naira is your profit, which is also the cash flow, the cash that flow into the business as the cash that you can touch, you can do some other things. So you can imagine uh, person who is not measuring all this, you are into the pricing just like that because the other competitors are also pricing that way. The price of possibly you are into food production, restaurant or whatever, or bread making. So a loaf of bread is sold by your competitors at the rate of a minimum, maybe 800 naira. You also follow the bandwagon without sitting back to look at other margins, other metrics. Then at the end of the day, you may end up not even making a net profit of 20%. Maybe you manage to make a profit of 10%. So now you don't even have enough cash to throw back into the business. So this is actually a very dangerous trend that can send the business into its grave very early. So without a price flow, discount becomes become losses. So we are very quick at giving discount to family, friends, and people that we believe would secure opportunities for us to protect our business. So we shouldn't be doing that. We should sit back and do our pricing right. Something we will see in the course of this presentation. So we should be able to track all our five metrics weekly and use them together. So these five metrics that you see, they are the core of the business. The revenue, which is the revenue from our sales of service or product. We may be in the manufacturing sector, we may be in the service sector, we may be in the product development sector. So whatever sector we are, so the revenue here is our sales revenue, is our revenue, the revenue that we talk about. We didn't say 100% because there may be wastages, losses, delays. Maybe we are unable to convert our inventory 100% to finished good. So at least we are able to achieve 85% from the input we put into the production processes or service, and it return back to us 85% of what we put as an input. So for the 45% gross margin, this is this relates to the cost of production. Some companies will call it cost of goods sold or cost of service. So these costs are directly traceable to the product and services that we are offering. No mix up, no salary is not there, rent is not there, depreciation is not there, insurance cost is not there. But this we are talking about the costs that are directly traceable to the product and services we are offering. For instance, for SMEs in technology, software development course, the software itself, possibly all those costs that directly affect the production of the service or good. Even for clean tech, direct costs relating to the, the equipment or whatever we use in providing the service. So then those direct costs are what we are looking at as, accounting for the gross margin. Then the operating margin are those other costs that are indirectly, but we need them actually to do the production of goods and services. The salaries, the rent, the bank charges, the finance costs if we have taken loan, the insurance, the depreciation of our equipment, the transport costs not related to the service itself, but other traveling costs in going out to make presentation to our clients and customers. We charge all this to our operating costs. Then finally, the net profit. Now, for instance, we were able to rake in 85 naira. I mean, so from this 85 naira, we managed to make 20 kobo as our profit. 20 kobo, 20 naira also as our profit. So we can see the difference. So if we are very meticulous enough, the net profit can even go more. We can make up to 25, 30%. Then the cash flow, which is the real reflection of what we get. At the end of the day, if all this effort that we make, we couldn't uh, acquire any cash, then it's actually a problem. It is not the situation that we want. So the next slide, and okay. So now, what we are saying, we need to take diagnosis before pricing. We need to sit back, do some kind of analysis. In a very matured ecosystem, we could even go to the extent of doing price scenario analysis, price sensitivity analysis. We have to look, we need to look at various scenarios. Okay, if our competitors are pricing this way, they have this price. Do we follow them? Do we join them? Or do we go the other way? So, but we need to carry out some analysis. If we carry out this analysis, we may end up getting a better. In fact, we could even sell. We could sell at a very lower price. You know, depleting our inventory, go back to the market, get more inventory, process them, go to the market again and sell. So what we're saying, a typical 100 million, 10 million naira revenue business can lose 1 million, which is like 10%, right? Or more. Two small repeated leaks. There are some small leaks, in fact, that can lead to a loss of 10% of the typical revenue. When I say leak, it can be leakage from money getting lost or the process itself getting, you know, when it takes you more time to process goods and services to go back to the market, to go to take to the market and sell. So this loss in time is also a leak because you will have to do a lot of. It will take you time to finish the product, take it to the market, sell, go back, get more inventory, process, and sell. So this waste of time is also money. So then again, if you have a very bad, well, let's look at them. Uh, First now, pricing. If you are pricing below the cost, this can also constitute a kind of leak. Pricing below the cost, you have a cost price for your item. Maybe let's still take an example of bread. You produce a bread which is supposed to get sold for 800 naira. Now, because you want to just finish up the inventory, go back to the market, get more inventory and process, you now sell the bread at 790 naira. You may think that that 10 naira is nothing, but it's a loss at the end of the day because By the time you sell everything and come back to do your mathematics, you find out that you have been operating at a loss. Then again, if you have a uh, very dirty workflow that is not well organized, not so organized, then there will be a lot of wastages, rework. You may need to reprocess over and over, whether you are in the tech, whether you are in the service, whether you sell hardwares, but you have a very uncoordinated workflow system. So there will be a lot of reworking, particularly for product. You know, you will have to go back over and over, back and forth again in processing that product. So for any process that you have to repeat, rework, it's a huge drain on your resources, and by implication, will lead to loss of revenue. So then again, let receivables. You have receivables are customers that have purchased your goods and services but have not paid you at that material time. You will still have to record it as a sale. Immediately they take delivery of the goods or services. But if it's taking them long to repay, then it will drain your resources because whether you like it or not, you have delivered the services to them or the product to them, then you may need to get more money somewhere to get more inventory and produce. Or if it takes long time for them to pay, time value of money is very important now. 1,000 naira this week may not be the same 1,000 naira next week. So not to talk of for a customer that has has your money, maybe 100,000 since February, February this year. Now, 100,000 is not the same today as it was in February. So this is a loss technically to the business. Then when you have discount without approval, at times your staff members can be so magnanimous. They would want to upsell, they want to sell more. They are very committed to the business. They believe that by the time you sell more, you can easily go back again and reproduce or acquire more inventory, go into production, then sell. So unauthorized discount because the staff concerned may not know the economics of the cost of good, what kind of calculation or mathematics you have gone through, what constituted the cost of the product or service. Without knowing that now a staff has gone ahead to approve a discount. So discount may come back to haunt the company. So the next thing is ideal inventory. The staff member actually can be conscious of this ideal inventory, thinking that okay, we have a lot of goods lying. It's better to discount, sell them, go back and get more inventory because the market is still big. So looking at this at the ideal inventory, whether with discount or not discount, if the inventory stays idle, unsold, unused, is also a clear link to your business because by implication you have actually tracked. I mean, you have actually kept your inventory, your cash seated in form of inventory within the business. Then another thing that can constitute a leak to your revenue is on track overheads. You don't do budget, you don't plan, you don't have a structured, you know, expenditure life cycle. So everything, yeah, you host these stores, you ask people to just spend whenever you have these stores, just entertain them, spend. Go there once there is an event. Go there, you could probably sell our product and services. So this is something that can also come to the drain. So yeah, in this slide now, I know what I have been saying. Some of these are very hard truth. They are something very hard to do as an SME. You have that sympathy or a kind of love triangle between the pricing and your customer. You have to choose between your business or your customer this time around. But the middle terrain between you is the pricing. When you have different prices for different customers, then it's also a very challenging thing. So now, which metric is hardest to track? When you look at all this, the room, you can see we mentioned about revenue, we mentioned about gross margin, profit margin, net profit, cash flow. So revenue now is the actual sales. You have to do a lot of things before the sales revenue come into the business. If you give more discount, the revenue will not be as it is. If you are unable to sell more, you can't bring in more cash. So generally, maybe it's something for us to to think of. Which metric is hardest to track among the 5 year? Whether it is the revenue, the gross margin, the operating margin, the net profit, and the cash flow. So, and you need to track all the revenue to actually all these metrics to actually come up with the requisite profit, the profit that can take the business to the next level, the profit that can enable the business to scale. So they are all critical factors, and the deciding factor for all this is the price. If you get the price right, then all other things here will fall into their places. Diagnose before you prescribe price. When you have the right numbers, you'll be able to play with your price. If you carry out price sensitivity analysis, you'll come up with various price points that you can be comfortable with. If your competitor is selling between maybe your price point A, B to C, then you are very much comfortable to decide where to go. Because you know if you sell at a price point A, you will still make profit. Point B, you will still make profit. Point C, maybe it just depends on the point at which you are. A price point A may give you higher profit, but at the end, in the long run, maybe some of the customers will disappear and go to your competitor. If you sell at price point B, maybe you may be comfortable. You may still keep most of your customers, and but any slight in price regime change will also affect that. But if you remain at price point C, well, maybe some customers will misconstrue that because okay, some customers may misconstrue that. Okay, next slide, please, Anne. So, in all doing this, to be able to determine your pricing, because you are dealing with customers, whether you are providing services or good. So, you need to be comfortable and charge your price in a manner that will keep your business afloat. So, you at times you may have to be choosy. You may have to select the customers that will actually buy your product. Because if you cite your business in a particular location, where if you cite your business in a particular location where customers can be comfortable with your goods and services, you are at the right place to charge the price. It doesn't matter. You may have a comfortable 100 customers that can see your product and services go into the cycle. You'll be able to convert your product and services into cash very quickly. So you may also need to address issues, sort, set in order, shine, listen to feedbacks from your customers so that you get the product right or services right. You don't just do things off head. Then again, once you have select customers that are willing to patronize your product and services. You are able to address their concerns. You listen to their feedbacks. You effect change. Then the next thing, you can charge the price based on the value you are providing. Because in charging the price, you need to be, value based, value oriented. Once a customer sees value in your pricing, definitely the customer will always come and buy your product and services. So use a value ladder. So, and can we get to the next slide? Next slide, please. But why value pricing? You know, value pricing is very important because if you select the right customer and address the waste and variation in your goods and services, then the customer will be very comfortable in the price that you are used to your product. If you select a wrong customer, then no matter what, whatever you do, you will not actually impress the customer, and you will have huge backlog of inventory of unsold goods and services. And then the end user will be lost, and the business will collapse. You also need to control your costs. Look at your revenue, look at your costs. There are some things that you can you can automate. There are some processes that you can automate. There are some things that you can do once. There are some things that you can actually aggregate and do at once. So all this, when you take these steps, you will succeed in controlling your costs. By controlling your costs now, your revenue will actually increase, then will lead to your a very good and better profit. So value pricing, as I mentioned, attach value. Look at your product as actually solving problems, a solution, a value to your customer. Once you have that mindset, then you are good to go. So, and next slide. So now these are the foundation to be fixed. As I mentioned, you select the requisite, the right customer, right client. You address the issue using all tools like this. You also allocate your overhead costs right. No mismanagement, no cost wastage. Then you charge appropriately. Charge a price that the customer will see value. Some clients, some companies, customers don't even question their product and services because they know the value is there to be seen. So next slide.
Sorry, sir. Sorry to cut in, sir. We have 5 more minutes, sir.
5 minutes. Wow.
All right.
Uh, so how do we manage the time? we although
Hi,
the
let's give him time to finish up his presentation. You may go ahead,
All
sir.
right.
okay,
Thank
Yes,
you.
Mike, I continue, sir.
hmm, okay. So we go to the next slide. Okay, these are typical example actually. We just trying to explain to us the direct cost, overhead cost, risk buffer, and minimum flow when we are actually looking at getting a correct price. This is the price flow formula. So we see direct costs, all those costs directly traceable to the product and services. 3,000 overhead, these are admin and other operational costs. Then maybe because we want to arrive at a price that can be affordable and be seen as valuable to our customer. So maybe we put a top 500 naira buffer, then we arrive at 4,500. This is the minimum that we can sell our product, for instance. So plus or minus, we can sell 4,006, 4,007, but it shouldn't even fall below the minimum flow. Although we have already covered our costs, when we look at the direct cost, the overhead, the buffer is at least a point whereby we may end up uh, break even, no profit bonus. So this is something that one of the methods that we can actually do to get our pricing right. Okay, we can go to the next slide. Okay, next slide. Now. So this is also the same pricing system, but looking at it differently from cost to value. So you can see the cost up to the point we establish the flow. So, but we can add some margin to arrive at the value price. This value price, we actually attach 40% margin. So because we are targeting particular customers who are very, I mean, they have tests. They know our product and services offer them a requisite value. So we can target some of these customers for this pricing. Then other customers, we can target them for the 4,500 value, while customers who can see value in whatever we do and what we are offering can afford to pay the 6,300. So it's another pricing strategy that we can adopt so that we have different pricing for different set of customers that we have within our ecosystem. So next slide, please. How does a non-price flow change by saying, okay, give me discount? So now the flow turns, this arrangement is actually very useful when we know that definitely we will be in for customers asking discount. So by the time when we have a minimum flow price of 4,005, that we can charge regardless of the discount. But we have a value price of 6,003 from where we can afford to give discount, but we know how much discount we can give. We need to be very strategic in giving the discount. We need to do a lot of negotiation. We need to look at our mathematics. If we give discount, what will happen? Are we trading on profit or are we trading on equilibrium? Uh, we, we actually break even, but even if we are break even, we can have some cash to go back or make some kind of scaling. So we should be less blind with discounting. You know, whenever we think of giving discount, we should be very creative. We should look at the consequence. We should look at the value. At times, too much of the discount will even whittle down the value of our product. People will look at it as a second class product as against the offering from our competitors. So next slide. Pricing must fund the cash gap. So if we are fixing our price, the price should be able to fund our cash gap. Profit is not equal to cash. We may still make a profit but not have the cash. So the conversion cycle, if the cash conversion cycle is, for instance, 60 days, so every cell can lock us cash for 2 months. That's the expectation. So the the thing here is that we should be able to convert our cash as quickly as possible and then go back to production again of goods and services, sell and convert again as quickly as possible. If we have some products that are quick in converting cash to us, then these are the kind of products that we should attach our prioritize and continue to make the product shine and churn them out at all times. So if we invoice within 24 hours, then we should have a lot of follow-up, then call just to ensure that we meet the 60 days conversion cycle. So we can take note of this. DIO, days inventory outstanding plus days sales outstanding minus days payable outstanding, which will now give us the cash gap that we are talking about. So this is in compliance with even standard operating guideline, international financial reporting standard. Yeah, for us to be in tune with global practice. So next slide, please. The next slide, Anne. Okay. Yeah. So one of the things that I mentioned that will save us cost is to automate automate costing so pricing can stick. So if we automate a lot of our things, receivable tracking, inventory control, SOP checklist, this kind of approval. For instance, now if you automate even discount, we just say okay, any discount beyond below 5%, staff can approve. Any discount above 5%, we have threshold and benchmark. So once we have this automated, then there will be no question of discount awarded discriminately. Then even the pricing now, if you have everything set and automated, we have our scenario and sensitivity analysis automated. So system will actually generate for us the various price points that we can choose from. We have our margin dashboard where we can even see our operating margin, gross margin, sales margin, everything tracked. So this way, our dilemma is actually taken off. We track our debtors receivable automatically. We can get that insight or a kind of uh, alarm escalation that this particular number of customers have reached certain days. You need to follow up. So different outcome will be revealed by the dashboard tracker if we automate the process. Even live flow for the pricing, we set a benchmark of 4,500 pricing and a target price of 6,003. So we have a window between these two prices to be able to award discount and do whatever. So the system now is automated. We can't go beyond the threshold of the system. We have a standard operating practice checklist also automated. So once a metric that we are tracking is going red, it will be, everyone will be, there will be a kind of display, and everyone will be called upon to actually know that what is happening. So then we get back our time and a lot of things. So the automation will actually save us a lot. We can have a lot of pricing regime there to rely upon. This way, the idea of pricing off head or following the bandwagon is taken off our head. So next slide, and so next slide. Yeah. So and next slide, please. Okay. So now customer strategy is the next. From volume to value. It's not about producing massive goods or having a whole range of services. So we need to attach value to all this. We need to no matter what, even if we get few volume but better customers that can sustain the business, that can always come to us, that we can return. So it's even a good one for us. So we need to be very mindful of the the scenery. So the value we are bringing to the customer is the most important thing that we should focus on, and the customers will always come back to us when they are getting the value they actually in research. So once we have the value there, everyone is seeing. You can take example of some of the products and services we see around. They charge price very high because customer know that once he acquires the product and services, the value is there. So retention is the profit engine. If we are able to retain as much as possible of valued customers who appreciate our product and services, then this will assure us of our revenue, assure us of our very lower gross margin and very higher profit margin. So next slide, please. We can see other metrics here. So investors fund margin discipline, not vanity revenue. Because we are all whatever we are doing now, we may be willing, we are always thinking of spreading into more areas that our businesses are not known. So we need fund either by way of equity funding, debt, or investors bringing in their money. So investors are looking at the margin discipline, not vanity revenue. If you make 100 million naira revenue, at the end of the day, it was a loss. The investor's confidence is already written down. So we need to focus on the right thing at the right time. We need to have a very strong governance, ESG, environmental, social, and governance basics. We need to track waste, safety, SOPs. We need to also be ready to pitch because we can only pitch if we are very confident of even our numbers. So we need to get good numbers, numbers that we can always parade to all investors, all approaching investors. We need to have the good practice, SOPs, and good management structure, financial control in place. So once we have all this, so when we are pitching, we will pitch with confidence. So investors will be looking up to at least gross margin greater than 40%. So net margin greater than 15%. Then cash conversion cycle. Investors will be interested in a business whose conversion cycle is always less than 30 days. Will be able to produce, convert to cash, go back again, produce, and investors will be always willing to support businesses that have uh, 80%, at least 80% SOP coverage. You have standard operating practice and procedures. You are compliant in all facets. So at least 80% compliant in all facets is something that investors will be happy to have. So next slide, please. So how does retention make you investor ready? You can see definitely retention. When you retain, the revenue will be there and even be multiplied because by retaining now, you will have lower cost of business, faster cash because you will convert as quickly as possible, and you will have a more predictable margin. So you see, retention now has led to all this. So it's very important for you to retain your customer. How do you retain customer? You need to be very intentional in the value you give to the customer. You need to receive and use the feedback you obtain from the customer so that you right the wrong. You always offer good services. You are a listening type of company. So once you have that, by the time you are doing that, you'll be retaining and also getting more and more customers and clients from your funnel. You'll be able to convert a lot of your funnel into paying customers. So you can only do that when you uh, when when you do the right thing, you offer value, you remove waste, you automate your processes, all those things that you repeatedly do, try and automate them. You operate in a lean manner. You do a lot of uh, lean activities. Check your processes always. Remove bottlenecks, bureaucracy, automate your discounts, benchmark with the industry, always benchmark. If you are into energy or production or service, benchmark with your competitors, then get the price right. So next, and so you need to for you to be able to retain and convert your prospect into profit engine. So you need to make the value funnel operational. So these are no brainer. The quality you need to for you to be able to retain, you need to maintain the quality. Always try to even exceed the quality outcome. Deliver good outcome to your customer. Follow up this road 70/30/90. So this 70 is about you are talking about the conversion, the your repeated cycle of sale, yeah, the days you take to even convert your inventory into finished good, then you convert the finished good into cash, then also you obtain feedback and do the process all over again to make sure that you retain the customer by delivering value. Then you need to upsell. You need to do whatever you can do to increase your motor score. So by the time you deliver good services, you follow up, you listen to your customers. The customers can also refer you to other customers. You need to also measure your customer lifetime value so that you don't wait even for the customer to give you feedback. You follow the customer, particularly when you are into product and services. So you don't wait for the customer to even issue the feedback. Then you also look at costs associated with even acquiring the customers. Are you spending more to acquire few customers? If that's the case, then you need to change the strategy. You need to spend less to acquire your customers, and you also need to retain the customer, increase that traction, the economic value of the customer, ask feedback, get customers information, but you need to be conscious of, you need to be very ethical, but make sure that the value is there. The cash cycle, 60 to 25 days. You need to actually target faster cycle of converting your product and services into cash. So anything by the time you spend more than 30 days and the inventory is not converted into cash, I mean the inventory, the finished good is not converted into cash, it's something that you should start debating upon. It's something that you should start pondering over. Next slide, please. The next slide, slide 19. We're almost getting to the end of the presentation. Price with the system, not guesswork, is what we have always been saying. Even in this presentation, I think we have mentioned this over and over. So we need to turn this session into three practical operating tools and weekly management rhythm. So we need to, by way of summary, we need to check price flow calculator, direct cost, overhead cost, risk buffer, and target margin. We need to apply this to top three SKUs. Stop keeping units, but just operating in inventory related ecosystem. Then also we need to scale, adopt the scale checklist. We need to search, we need to charge, we need to actually ask, administer, learn by our mistakes. We need to explore. So we need to get our SOPs right. We need to carry out 5S audit for all our process. 5S in the sense that we need to look at sort, set in order, standardize, sustain. and so on and so forth. So we need to also adopt a kind of discount guardrail. Discount should not exceed a particular benchmark. We need to actually automate the discount process so that whether the CEO or the people behind the 20 are there or not there, then no one can actually go beyond the threshold. Then our receivable recovery cycle, we need to also check that by the time we keep on giving out our goods and services on credit and we are not following up, at times this will consume the business because we'll have all our entire capital seated with our debtors, our customers. So the cash conversion cycle, we need to look at it 30-30, follow up the DIO, days inventory outstanding, the days sales outstanding, DPO, the formula we have seen. So we need to do that as a routine, as something that we do all the time. That's the only way we can guarantee the business continuous survival. So this is a summary of the weekly management review. Margin, discount, receivable, inventory, customer profitability, then the next action that we need to do. So the next slide, which is probably the final slide. So now we can see the how far we have gone. We have so far been having conversation on price with a system, not guesswork. So revenue is vanity, profit is sanity, cash flow is the reality. Because with all this now, if at the end of the day no cash gets into our bank, then I think we have done nothing. Work is zero. So we also need to look at the scale. Scale is uh, a framework from Agidius uh, that we actually need to look at whenever we are doing our pricing. We need to, by way of this scale, we need to select the right customers. We need to address waste. We need to charge value. When we are charging our pricing, we should bundle the pricing with value. The customer is actually receiving value. Then we need to execute for scale. We need to find ways of maintaining the momentum so that survival will be something that is guaranteed. So thank you so much for listening over this more than an hour. We've been discussing on pricing, the pitfalls, the steps to take, and the way to position ourselves for growth and survival. We shouldn't follow the bandwagon. We should be very meticulous when we are pricing. We should do our pricing with a system, not guesswork. Because by the time we guess, it will backfire, and the outcome will not be, something that we all like. So thank you so much. So I think we have covered the slide.
Yes, thank you so much, Mr. Shehu. We really do appreciate you. Can you hear me, sir?
Yeah, I can hear you. Thank you so much.
Yes, we
Yes,
can hear you.
yes. Thank
We
you.
have had to
Come again?
encounter technical glitches here and there. So
Yes,
this
yes,
is part
truly.
of
But then,
mm,
go ahead, sir. Please conclude, sir.
yeah. So these are part of the price leakages. You know, imagine in a
Mm.
normal business when you have these technical glitches, they will affect our workflow. So our customers and clients will get our product and services at the right time, the right place.
That is so true. That is so true. And thank you once again, sir. I like how you linked the network situation with pricing. It just shows that the topic that we had today was really covers a whole lot, even above businesses that we do. So
Exactly.
thank you once again. Good morning, everyone, once again. And this is like a second welcome. Thank you so much for staying with us thus far, and thank you as well to Mr. Shehu. Thank you for the wealth of knowledge that you have brought,
Thank you
the
so much.
years of hard won experience that you've also brought, and it just showed that for every point that you made, they were clear, they were practical, and then they were also rooted in real world practices. So please, House, can we just show by the use of our applaud smileys? Can we just appreciate um, Mr. Shehu? And I see those hands clapping for Mr. Shehu. He has done so much for us, right? Because he didn't just give us theory, he gave us tools, he gave us literal tools. He took ideas that can feel intimidating, things like margins, cash flow, price of value. These are things that probably we've heard, but I don't really think that we implement them. And even if we do, not at the magnitude, that we will want to do that. And he made them make sense. So that is a very rare gift. And we really are fortunate to have learned from you today, sir. So thank you. Thank you
Thank you
once
so much.
again.
Thank you so much.
Thank you. Please let's not stop our applause. Let's not stop our applause for Mr. Shehu. This was wonderful. Thank you. Thank you. Thank you, Ms. Anne. Thank you so much. So before I keep talking as we're going to the next stage for Q&A, I would want us to I would want to hear from us. Let me put it that way. And we're going to do this next part together. So everybody is going to be active. Everybody that who is part of this is going to be active. And what we have is our Mentimeter. For every responses that we get to see it in real time. And also, Mr. Shea would also get to see it. And probably if there's anything that poses as questions that he would want to respond to, he could go ahead. Although there's also a space for Q&A. So if you check the chats group, before we go any further, if you check the chats group, you would see the link for you to go and be a part um, of this pulse checker. So can we confirm that we've all hit the link and then we're ready to take on the questions? I can just you can notify by the show of a thumbs up or all right. Can we all confirm that we are in and we can start with our responses? Yeah, so we also have the QR codes there. If you can check the chat box, we also have the QR code. So can we go ahead? All right. So the first question is pretty easy. Or let me not say pretty easy. After all, we've learned a whole lot and we've learned so many interesting things today or this morning, right? So the first question, and it's going to come from the first few slides that oh, we already have an answer. That's beautiful. That Mr. Shehu touched on. So he says, why do SMEs chase revenue but lose profit? So name one silent trap you've seen that erodes profit. So we have one that says low margin businesses, and that's quite right. Mr. Shehu mentioned it as one of the ways that while SMEs are chasing revenue and lose profits, it can act as a silent trap. So can we have many more responses? Oh, good. High competitive businesses. Hmm, true. So that's another silent trap. Can we keep our comments coming in? Can we keep our responses coming in? I like those two responses. Low margin businesses and also high competitive businesses. Sounds like the two extremes, if you ask me. I remember what Mr. Shehu said at some point where he said that revenue can fool us and it to make it look like the business is doing well. He even gave us an example of when he went to a business in
Exactly.
Abuja, right?
Yes.
And then he mentioned that the people were looking busy, moving up and down, carrying out activities. But on paper, or if you check the books, you will see that the business was actually not even doing well in terms of profit and
Exactly.
all of that, right? So let's not allow the revenue to fool us, right? So it's always good to point out the silent traps, right? so that we don't chase just revenue alone and then end up losing profit. Okay, so that's beautiful. So let's go to the next questions. We have two responses. So let's go to the next question. All right. So the voting is in process. Good. And we already have, I think we're to have our responses come up now. Hello, team. Oh, okay. So actually, that's good. So more responses came in rather. So as some of the silent traps, one of them was growing revenue in order to get bank loans. Ah, that's very critical. And the other was not factoring in some overheads like rent. That is so true. So, just trying to balance the books, and then sometimes you just don't factor certain overheads that should be there, that act as variables sometimes that should always be there. And then most people just believe that, oh, they're making that revenue, and then they don't realize that, profit is actually slipping out of their hands.
Exactly.
So the next question was to point out which of the metrics is hardest, right? And we had some options. Good. So which of the five core metrics is the hardest for you to track accurately in your business? Now, let's not forget, while we are answering these questions, it's not just based on, while yes, we would hold on to what Mr. Shehu has taught us, but also we want to know your own personal experiences in terms of business, right?
Exactly.
So
Exactly.
which of them are the hardest? Is it revenue, gross margin, operating margin, net profit, or cash flow? So, with your own business experiences, which of these core metrics do you think is the hardest for you to track accurately? Okay, so we have one vote that says operating margin. Thank you for that vote. I think operating margin is actually leading. We have two saying operating margin. Oh, good. Well, this is so good to know. So, Shewa, are you seeing these figures?
Exactly. Exactly.
Yeah.
Yes.
So, operating
And it is
margin,
not
one of the
quite
hardest to track.
surprising.
Truly, truly. One would want to argue that it's maybe between the cash flow and gross margin,
Yes.
but it's interesting to see that it's operating margin.
Exactly.
So please let's keep the votes coming in. I think before I even go any further, are we all signed in, and are we all attempting the Mentimeter, or are we having issues trying to sign in? Okay, so we'll move to the next question. I think the two that we have is an indication, right, that it's been used already, and then we're attempting them. Okay, beautiful. So what hidden leakage makes that metric hard to track in your business? So for those that of us that said that it was operating margin, what is it that makes it hard to track? Hmm. Okay. What is operating margin itself? Okay, try to have an understanding of operating margin. So, Mr. Shea, while the questions are coming in, while the responses are coming in, maybe just some that ask a question and maybe would need some
Clarification.
brief and concise definition. So things like operating margin, we're seeing that it's a hard metric to track, but maybe it's also because people don't necessarily understand the concept of it. If you could just touch on it
Exactly.
for maybe a
So,
minute. while we take
Okay,
on
okay,
other responses?
okay. So you see, the operating margin is a measure of your cost around administration. Those costs that are not related to the production of goods and services you are engaging, maybe your salaries to administer, rent, depreciation, bank charges, transport, local transport, or even outside transport that has no linkage to your product and services. Then all other expenses for running of the business, day-to-day run of the business, diesel for the business, electricity, payment for internet services. So you do these expenses to be able to run the business. So this is what the operating margin measure. It measures those.
Oh, that is beautiful, and that is actually very explanatory. So they are like the costs that are not relating to what you produce or what you sell or the services that you render, but actually costs or expenses that come about from the running of the business,
For
maybe
the business.
rent,
And
having to handle
regardless of the volume of
machinery,
the
staff
business,
cost, and all of that.
yes,
Ah,
because I
so
can
basically,
see
every business has an operating margin,
margin
operating cost.
exactly, and
Yes,
it doesn't vary with the volume of the goods and services you produce. Whether you produce 10,000
beautiful,
units or 5,000 units, it's the same cost. But for
beautiful.
the for the cost of goods sold, so you see that one varies with the volume of the product and services you churn out.
Okay, beautiful, sir. So that's thank you so much. That's Mr. Sheo responding to one of the responses that was there. So another said data costs, transportation price fluctuation. So that's by I think by Mr. Sheo's definition that also will fall under operating margin. And yes, the last says having to do accounts every day. It can be quite, yes, it's asking effort having to do accounts every day. But as we have learned today, it's very important for
Very, very
the
important.
growth of your business and knowing where you stand in your business, especially having to track profits, losses, and even revenue in general. So
Yes,
thank you for
yes.
that. Thank you for responding to that question. So let's move to the next question. So let's move to my next pulse checker. And please let's do well to join in the activity on Mentimeter. Good. So the next question says, before you can charge for value, what must you fix first? So in who you serve and the waste you carry. Do we get the question? So before you can charge for value, what must we what must you or your business fix first in who you serve and in the waste you carry? So I have a response that says family responsibilities. Truly, because those have a way of creeping in. Let's be very factual. And I like that this person is having this response to it because uh, this is their reality, I would want to assume. And it just shows that if this is not sorted out, you won't be able to tell when maybe um you won't be able to tell when maybe there's an issue coming up and you have to attend to it because it's family, and then it now becomes difficult to have to just marry everything together. So one other response says who you serve and know your customers. Okay, okay, that's a good response as well. That's a good response. We're actually taking note of all of these responses as they are coming in. So thank you very kindly for the response that you're giving. Ah, wow, beautiful. So before changing for value, I must first fix where my revenue leaks and account for all overhead costs instead of charging based on emotion. That's beautiful. Truly, truly. Rather than charging based on emotion, it's good to actually, track all those things first and fix it. So attack waste first. Beautiful. Sometimes waste can't be fixed until you scale. That is an interesting take, actually. That is a very, very interesting take. Beautiful. And you can see Mr. Shehu is actually even giving a thumbs up because, yes, these are also very, very Actually, very, very interesting take. So thank you all for your responses. The next question. Next question, team. Ah, beautiful. So this is the discount ask. I like to call this the discount ask. So you know your true price flow, right? Mr. Shehu took us through that process of knowing how to price. I think I put it down here, in fact, in my notes because I was really following. I was trying to be attentive. So started with direct costs, then went to overhead, then risk, then we now had the price flow before value price. So now that you've known your true price, you've accounted for everything, you've known your true price flow, a customer then asks for a discount. What do you think you should do? Let's make it real. Imagine you've done all the work. You know your true price flow and everything is this is the amount, 4,500 naira. And that's the line where, in fact, if you go below it, you make zero profit. And now a customer is coming to look for it. So which one are you willing to do? Negotiate more, or you are less willing to negotiate, or it just depends on the customer. Maybe it's family or something. So which one is it? Oh, I'm seeing responses saying willing or less willing to negotiate. So you'd want to stick to um, your price floor. That's very interesting. That's very interesting. I know some people that will even maybe they know that this customer is going to seek a discount. They will try to elevate their price floor a little bit, so that by the time you are telling them, okay, this is a discount, you are actually even around your price floor, and that's fine by you. Well,
Exactly,
those
exactly.
are those are the little tricks in business that you learn once
It's
or
true.
twice. But
It's
yeah,
true.
that's beautiful take. So that's wonderful. Thank you, Mr. Sheo. So that's wonderful. Thank you for your responses. So for the sake of time, let's move on to the next question, team. Let's move on to the next question. Yes, beautiful. So this is the why, and it's interesting. Oh, okay. So I have a comment. Before I take that question, I have a comment that says, it's in the chat group. Some customers take undue advantage of you because you don't charge high, like every other competitor. Because the business is growing, you don't want to lose your customers. So please. Okay, so this is a question that maybe after this we would tailor this to Mr. Sheu. So please, Akpayemi, you will hold that thought, and I like where this question is going. So what will happen is after we take the Mentimeter session or the pulse checker session, we will then go into the questions. So I'll just leave that space in the chat box. So please, if you have any other questions that probably we're not taking now, you could just leave it in the chat box. Then I would have that session where we can either have to speak to it or would I'll read it out some responses to them. So, Shehu, can we do that? Can we work around that after this session?
Yes, yes, of course.
All right, beautiful. So on Mentimeter, the next question says that how does knowing your price floor change you or change how you handle a discount request? Beautiful. So one question says it enables me to know what line below which I will be selling at a loss. That is very true. And you know that bringing down the price means or yes, so bringing down the price means losing profit, which also would then go about or bring about stagnation. That is a very, very beautiful take, and that is very, very wonderful. That's very, very wonderful. So thank you so much for that response. Do we have any other question? Team, do we have another question? Maybe the last few or even the last one. So how does keeping customers longer, that's now to retention, how does it lift both your profit margin and your cash flow? So this is not just about opening the doors for customers to come in, but this is also about closing the back gates or the back door so that they don't walk out. So how do we retain them and how do we keep them longer? Or sorry, how does keeping them improve your profit margin and also your cash flow? So we'll take a few responses, and then we would have would have that question and answer session where a few of us would want to ask Mr. Shehu a couple of questions. Would be free to ask, and also I would also be taking the question in the chat box from Apayemi. So let's have our responses. I think this should be the very last one. So I think we're about 11 responders. So how does keeping customers longer or retaining them, how does it lift both profit margin and cash flow? Like I said, opening doors, reduces CAC. I would like more explanation on that actually. It reduces CAC. Quite an interesting take, but I would like some background to it. But thank you for your response nonetheless. Offering and prioritizing value my business offers ensures customers return and stay, and also recommend me to others. So word of mouth marketing. So it will equal more cash flow. That is very beautiful. That is a very interesting take. A very, very interesting. And that's very true. You keep them, you keep on giving them offers, you allow them to stay. And before you know it, you don't even have to pay for adverts because they would be your advertorials basically doing word of mouth marketing for you, as the case may be. One other response came in. It says it increases, in fact, two more. It increases revenue, which can increase profit and business growth. Yes. Well, once you have loyal customers, it's always very hard to take away loyal customers from you because at that way they are fixed on you. They know that okay, if they want something, they can always come to Mr. Shehu. If they want something, they can always come to Miss Anne. They don't need to go to a new customer, a new seller like Mr. Arnold. They've always been working with Miss Anne or Mr. Shehu, so they don't need to really change. So when once you keep them, it's true, really, you increase your profit and also business growth. And the other says reduces the need to rediscount to win business back. That is true. So they know you for your value you give, they know you for your price, and you don't have to be giving discount to every new client that comes in. Your already existing customers know you, and then when your price is maintained, and even when you want to take a price hike, if you follow the good due process of explaining to them the reasons as to why you want to take this price increase, they would loyal customers tend to always understand and still follow through. Another one says it sustains growth, and that is very, very true. So, for the sake of time, I'd like to close this Mentimeter session here. But please, let's also take a look at what we've done. We've been able to name silent traps. We've been able to find our hardest metrics. We've been able to agree how we fixed our price floor, before discounts coming to take us off it. We've been able to basically say, build our price floor as case may be, or give ourselves the spine to stand on that price floor. And also, you've also been able to connect retention to both profit and cash flow. So that is, in fact, generally the whole concept of being profit ready, or having the profit ready mindset. And the good thing about it is that it came from you alone and not from me. So your responses came from you. So it just shows that you have been actually very attentive and you've listened to all the takes that Mr. Shehu had said. So for the sake of time, oh, apologies. I didn't know I was muted. I didn't know I was
Oh,
muted,
sorry.
but it's
So
time for
sorry about
Q&A.
it.
So I would say I can't remember where I stopped, but I think I was already attempting Apayemi's question, and I was throwing it to Mr. Shehu. He asked a question, and he said that some customers take, or he or she said, some customers take undue advantage of you because you don't charge high like every other competitor. And because the business is growing, you don't want to lose your customer. So please, what is your advice for a small and growing business?
Okay. So thank you so much for this question. My advice is that you stick to value pricing. If you if a
Mm,
customer sees value in your product and services, so I think even with the price rise, he will still be calling your product and come for your goods and services. But don't be quite stereotyped by losing the customer, because if you have like 40 customers, 35 are
mm,
valuable customers that value your product and services. So you shouldn't
mm.
prioritize on one losing one customer at the expense of the other 35 customers. So I think
Ah,
maintain value,
beautiful.
follow the scale framework. Search for good customers, valuable customers, so that you can charge them. It's just like citing your business premises in a ghetto area where maybe only five household people value your services, but you are targeting mass
Mm.
market. So at the end of the day, you may not get the market, and the goodwill and reputation of the business will get distorted. So value pricing is the answer.
Okay.
Yes. Stay
Thank you so, so
at
much,
value.
sir.
Yeah.
Thank you so, so much. Apparently, I believe that also responds to the question that you raised. So, still stay on value and also stay on those your loyal customers. So don't necessarily fall or give way to what most of the customers will request for. So please do stay um, rooted, just like as Mr. Shewa says. Please stay rooted to still giving value and also maintaining the customers that you have. Thank you so so much, Mr. Shewa. Would there be anyone who has questions to also add to this, or can just leave that in the group while I would be making way for Miss Nina to come speak to us and then also close out this session? Okay, all right. So I think at this point, I would like to welcome Miss Nina. But before I do, please find in the chats there that we have the QR link, the link to the feedback where you can give in your feedback. Give us your feedback as to what you, how your feeling was during the webinar. Thank you very much, Apayemi. Thank you for that feedback. Thank you that you were able to get your response from Mr. Shehu. Thank you so much. So please, the QR code is also on display for you to, just tell us how you felt throughout the webinar. Give us your feedback. Let's know how you feel. Let's know how you were able to enjoy yourself or able to take in most of the things that were shared by Mr. Shehu during this webinar. And without further ado, I would like to welcome the Chief Innovation and Growth Officer for Clean Technology Hub, Ms. Nina, who would come, give a vote of thanks, and then there any other things you'd like to talk on before we close out the session. Thank you once again, all, and thank you, Mr. Shehu, once again.
Thank you so
Thank you,
much.
Arnold. Thank you very much. Good morning, or rather, good almost afternoon to everyone on the call. Thank you all for giving us 2 hours of your precious time this Tuesday. And thank you for staying through to the very end. It was quite an insightful session. I learned a lot, especially on the 5 metrics, before you get into your pricing. That was very insightful. And some of the tips and tricks that Mr. Shehu gave. So thank you once more to our guest speaker, Mr. Shehu, for joining us this morning. It
Thank you
was
so
really
much.
an interesting one. Thank you. And thank you all to everyone who participated in the webinar today. We look forward to you joining us in our next webinar series, which will be coming up next quarter. And also, we would love to hear from you. So the QR code, which is on the screen right now, please do feel free to give us your feedback. It is only from the feedbacks that we are able to, iterate and go back and make it more better and more informative for the next session. Interestingly, it was from feedback from the Q2 webinar series that we did that we had, this webinar that we're having now in Q3. So of course, your feedback will be very valid, and it's based on the feedback that we get, we're able to, continue to iterate and get better in the webinar series for founders, which is for entrepreneurs, SMEs, nano, micro, able to support you guys based on the fact that we are playing in development space, and we work with a lot of SMEs within our ecosystem and with externally as well. So thank you all for joining us this morning. And I do hope that you have a productive rest of your day. So thank you. And thank you to my team as well, who have been very active in putting this together. So thank you and well done, and have a great day. Back to you, Anne.
Thank you so much, Miss Nina. Thank you so much, Mr. Arnold, and a very thank you to our speaker, Mr. Shehu.
Thank you so
We really
much.
appreciate you. We are not taking this time for granted. Thank you for being part of our webinar section this today and this quarter.
Thank
I
you so
hope
much.
when next we call for your attention or any other thing, you'll be willing and ready
Yeah,
to.
yeah, thank you. I'm always willing, ever ready
All right.
to.
Yes, sir. Thank you so
Thank you
much.
so
Miss
much.
Chinyere from Spark Ventures will see you. Thank you so much for joining. And before, please, our QR code is still there displayed, and the link is there. We can go ahead and do that. But before we close this webinar, we want to see you. I want to take a picture of everybody that attended this webinar. Can you please use your video? Can you do that for us? Okay. Miss Atsimi, are you ready? Please, Mr. Shew, please want to see your face. Mr. Arnold, should I call you one after the other? Mr. Arnold, Mr. Shew, please use your video. Let's take a group picture. Are we ready? Everybody say cheese.
Hey,
Cheese.
cheers.
Are we good to go?
Yes.
Let's take from different angle. You can change your style, another style, be like that. So thank you so much, everyone. We really appreciate you. Please give us feedback. We have our email address. We have maybe a WhatsApp. Please give us feedback. We appreciate your feedback. And if you know that you are not following on our social media handles, please kindly do that. Clean Technology Hub. Please follow her social media handle. We have so much to offer you. Believe me, trust me, we have so much to offer you. We have webinar series, we have incubator program, accelerator programs, we have trainings. So you don't want to miss out on all these that we have for you. We don't leave you like that. We hold your hands till your business gets to a level that you will look back and say, yes, um this is what or where I want to be. So you can follow us on our social media handle, and we would like to have you as a family and part of our community. So once again, we say a very big thank you. Apologies for taking a few minutes of your time. We really appreciate it, and I hope we got value for what we learned today or the knowledge we acquired today. So thank you once again. See you in our next webinar.
Thank you, Anne. Thank you, everyone.
Thank you, Ma.
Bye, everyone.